Not yet. Well, okay, let's just get right into it this week, kids. Let's just save you the pain of drama. One of the things we talk about a lot on the show is mortgages, buying a home. And one of the questions I think Saied and I both get in the DMs more than any other question is the scuttlebutt, if you will, the rumors of does it make sense to pay your mortgage twice a month versus once a month? Why? Because social media has every single person from every single age demographic talking about how you can actually save on a ton of money over time by paying twice a month instead of just once. And this interest saved over the course of years of your mortgage loan could be hundreds of thousands of dollars depending on how big your mortgage is, right? Well, is there truth to it? Yes, there is.
Yeah, there definitely is. And another thing that's really gotten popular over the last several months that I've been seeing on all the social media pages is not even just twice a month, is pay your mortgage weekly, right?
Yep.
That way, if you pay it weekly, by the end of the year, you will have made one extra payment at the end of the year, which would potentially save you somewhere between 6 years to 7 or 8 years, right?
I think the problem with that is it doesn't resonate for most people because most people in the United States, I did some math today.
You did math?
Every once in a while, I do some math. I did some research. And approximately, as of January of 2024, approximately 90% of America is a W-2 wage earner working for somebody else.
Oh, I saw this, yep.
Yeah, we posted it to our social profiles, and you and Haroon blessed the image.
Yeah, I saw. I like what you did. You also put it on YouTube.
I did.
I liked it.
I did put it on YouTube. So that means 90% of America falls into this demographic, which gets paid, generally speaking, twice a month.
Right.
Whether that's the 1st and the 15th or the 10th and the 20-something, everybody's got the kind of the spread on it. So it makes sense for most people to take a little bit from that paycheck and pay down the mortgage when they do it if they're going to pay more than once a month.
Right.
So we have two scenarios that Saied has graciously handpicked where you can look at the implications of hacking your mortgage to save money and time.
Right. This was actually sent to me by one of our listeners. Shout out to Logan.
Oh, Logan. Mm-hmm. Yeah, my guy. Jake and Ben, they both own a $500,000 home with a 30-year mortgage, $400,000 mortgage, and a 7% interest rate. So, effectively, this is the mortgage interest rate that you would get today.
Yeah, exactly. That is the 30-year fix currently right now, and that is actually a 20% down payment.
Yeah. So, Jake makes monthly payments of $2,661. He takes 30 years to pay off his mortgage because he's paying according to the terms, the way all of us traditionally think we would when you get a mortgage. He pays interest of $558,000. That's a lot of interest for a $500,000 home.
Yeah.
So Ben, on the other hand, who looks kind of nerdy, just going to be honest, the pictures here are a little questionable, whatever.
Exactly. A little like Bill Gates.
Well, Ben, not so baller, decides to make biweekly payments of $1,330. So effectively the same payment split up into two. But he takes 23.7 years to pay off his mortgage instead of 30.
Right.
That means he only pays $420,000 in interest paid. A whopping savings. So in the 6 years plus of payments that he's now not having to make because he paid ahead of this, right? He paid in advance. It's $138,000 of interest being paid by him by paying this way. Now, you might be saying, Chris, what the fuck? Why?
Right.
It has to do with the application of your payment and the interest that accrues over time. So if your lender takes that payment and applies it when you make it, okay, your principal balance is now being reduced. So your interest total for the next 2 weeks is actually less than you otherwise would have had over the course of your loan. You pay down another payment in the next 2 weeks, right? So now you've got you're paid less interest, you've accrued less interest over that time because your principal balance is lower. Now you take that 2 week period and you magnify it out over the course, in this case, of 23.7 years, and you saved a lot of money in interest. And that $138,000 in savings really saves you years of payments because you didn't accrue it.
Right. So then the question really here that we get most often is, if I have extra money, should I be allocating it more? Because at the end of the day, this Ben, from these examples, is paying more per year than Jake is. And he's able to do that because he is making, I guess, more money, right?
So, I mean, he's not, no, in this example, he's not paying more.
Well, he's paying more frequently, right? Well, at the end of the day, he has excess cash flow that he could apply towards this where he's not paying it towards other loans. So first of all, we need to congratulate Ben and anyone that's capable of doing this, because you have an excess cash flow where 60% of America or 65% of America is living paycheck to paycheck, first of all.
You know what bothers me a lot about us having to make that statement?
Yeah.
Is that anytime we post something on social media and we talk about the benefits, like, for example, you just went viral, 1.2 million views on TikTok.
I'm up to 1.2?
1.2 million. Yeah.
Say it again.
You're a goddamn celebrity. You're approaching 1.3 million. It's to the point now where the numbers don't change because it's a small decimal. It's 1.3 mil.
Yeah.
Like, you know, it's not like hundreds. And I'm like, fuck this guy. Anyway, and it's on my account, which is even more insulting.
Yeah.
But in any event, you go viral, right? And one of the things you did is you read the breakdown of investing in the S&P 500.
And the effects of compound interest.
And compound interest, adding back average dividends over the life of, a period of time that we identified to get to $1 million. And the title is simple, $1 million guaranteed.
Yes.
This is one simple investment you should make. Mm-hmm. This one that we're talking about now with housing and payment, this is another simple suggestion that we make. But people unilaterally want to tear this shit down. They want to say, well, bro, nobody's got the money for that. Or nobody's got the... Look, I get that. Mm-hmm. We both get that. We all get that. Number one, pay down your high yielding or high expense credit card debt. Pay that down.
Right.
Number two, get a reserve account that you got 6 months of reserve in your accounts. Number three, start to think, okay, do I want to invest? Do you have a 401k with your employer? If you're that 90% of America that's got a job working for somebody else,
right?
Do you have a 401k? Do they match it? You should be contributing the match.
Which I've been hearing a lot of rhetoric going around that maybe in the coming years that might go away.
It very well may, yeah.
But to your point is the key factor here that you need to consider, okay, is the interest rate. The interest rate on your loan. For this person right here, for these two individuals, they have a 7% interest rate on their home loan, okay? By making an extra payment, right? By saving this 6 years, you're getting 7% rate of return on that money, on that extra money. Okay, it makes sense, right? Where else could you possibly invest it to where is really worth the risk of outperforming 7%? Maybe the S&P 500 over the long term because it averages 10%, right? Over the long term. But if you have, let's say, a home loan like, let's say I do, right? That is around 3%. Maybe. You got less. Don't do this. I knew you were gonna mock me.
What's my mortgage interest rate on my home?
2.9 some. 2.8.
2.71.
2 points, even better.
Yeah, it's
2.71. Mine's 2.99, I believe. Yeah. So now maybe for me it might make a little bit more sense to put that money, make my normal payment, but also invest on the side because I could get the arbitrage, if you will, right? I could be making more money investing. But if it's going to be hard to compete with 7%, and at the end of the day, if this is going to give you the peace of mind that you're looking for, then maybe go down that path.
So I've got a different kind of couple thoughts on this. If you're young and you're buying a home, your first home, I would say you should probably make the single monthly payment if that's your primary residence and if that is affordable for you to do. Because the long game of you investing that money into other investments, even if you stop doing it and start doubling down on your monthly payment or start putting money into your home a little quicker, that over time will build a nest egg that'll continue to build with compound interest.
Right.
So I like the idea of maximizing your risk and diversifying it. Mm-hmm. So to me, that means a 401k investment if you're employed with somebody else. If you're self-employed, then if the investment if your business is strong enough, you don't need to invest in it anymore. Your investment number one should be your business. Number two, you should start thinking about how to grow and scale your business. And number three, you start thinking about retirement at that point in time. Once you got to a point where you have sufficient cash flow to start thinking about bigger things.
Absolutely.
But all of this comes down to progressive load. All right. When you're young, just having a mortgage payment is scary. Right?
Right.
So I get you might not want to make biweekly payments. As you get older and you get more experience, you're going to come to the realization, wait a minute. Maybe paying off my mortgage isn't the best thing for me to do. You're going to go, wait. I've got a CPA. My CPA tells me that I get a tax benefit up to a certain dollar amount based on where you live, what state you're in, what your tax basis is, what type of employment you have.
Because you get to write off the mortgage interest paid, right?
You may be able to get write off some of the mortgage interest. You may be able to write off like a home office. There's lots of different ways to kind of skin this cat, if you will.
Okay.
But you may have a need to have a small mortgage on your property. So you might say to yourself, okay, well, I don't need to make biweekly payments anymore because this mortgage balance is fine. I can make a payment once a month because really all that interest is going to be deducted from what I owe from a tax perspective at the end of the year.
Right.
But when you're starting out, make monthly payments, be fine with that.
Exactly.
If you want to be thoughtful and pragmatic about hyper accelerating your payments and paying this down, sure, pay biweekly. But I don't think everybody should jump into that. It's sensationalized and sexy as it is to own a piece of real estate. I get that. I do think you have more value over time in investing in other things when you're younger.
Right. I mean, this ultimately should be the goal, but for most people out there, I think the average person buys 4 or 5 homes throughout their lifetime, right? So unless you're planning to stay in this place for longer than 6, 7, 8 years, this may not be worth it for you in the long run, right? Because you're not going to get the equity appreciation that you would probably like over that time frame. We're talking about the person here that really wants to keep this home, maybe keep it in their portfolio. We've routinely said on this show over and over that if you're buying your first home, try your absolute best to not stretch yourself out so thin to where you can't ultimately, eventually, as you grow in your career, maybe hold on to this property, this loan, you have it as an investment property, and then move into your next home and you can rent this one out and have more cash flow. Right?
That's another point, too, I think a lot of people miss is as much as it is to think about real estate and buying a bigger home and all these investments and everything else, okay, paying down your credit card debt is an important first step, right? Having a reserve of savings is an important first step. Just doing those two alone puts you ahead of most Americans.
Absolutely, yeah.
Far ahead. So there's nothing wrong with starting there, even though you're thinking to yourself, well, Chris, this doesn't really grow my net worth right now. This just prepares me for that. Yeah, it does. I get it. But the younger you are, the less expensive your monthly living and reserve will then be, and the less debt you should, in theory, have because you haven't accumulated over time at high interest rates.
Right.
But once you're there, a lot of people will say, well, hey, man, you can invest in this, you can invest in that. And I say, no. Where is your income level, right? If your income level is, call it below 100,000, that's an approximation. There's no, hard and fast rule there. But if your income level is below $100,000 in the United States, you need to find a way to get your income there from your primary wage earning job. If you're not earning that much, at least in this country, unfortunately, whether you like it or not, it's really difficult to invest aggressively enough to really have a quality of life while you're investing.
Yes.
And we're not the kind of people who are going to tell you to skip the latte.
No, we're definitely not going to be that person. But to your first point, why it's so important. If you're even this type of person that finds this sexy and you want to do this, and you want to get a 7% return on your money because you'd be saving that on that 7% interest rate, you better not have credit card debt where the interest rate on that credit card debt is 20%.
Yeah.
Okay, so like your money's better served over there, paying that down, save 20% over there versus the 7% here.